Silver prices are moving higher again, now trading around $48.40 per ounce. And according to FX Street, the main reason behind this surge is growing speculation that the Federal Reserve might cut interest rates in December. The article points out that new U.S. job cut data released by Challenger Gray and Christmas showed more than 153,000 layoffs in October, the highest for that month in over 2 decades. That number signals a cooling labor market, which often pushes the Fed to ease monetary policy. FX Street notes that traders are now pricing about a 67% chance of a 25 basis point rate cut in December, up from 62% just a day earlier, based on the CME FedWatch tool. So why is that important for silver? Because silver, just like gold, is a non-interest-bearing asset. When interest rates fall, or are expected to fall, metals tend to look more appealing. Investors no longer earn as much from holding cash or bonds, so some shift into precious metals. At the same time, lower rates usually mean a weaker US dollar, and when the dollar softens, silver prices often rise. FX Street also mentions that the extended U.S. government shutdown has boosted safe haven demand for precious metals, including silver. Political or fiscal uncertainty typically pushes investors to assets that can hold value when markets are nervous. So right now, silver's move makes sense. Weak labor market data, rising odds of a Fed rate cut, and safe haven flows due to the U.S. shutdown. Those 3 factors together are lifting silver toward the $48.50 area. Of course, it's not guaranteed to keep climbing. If inflation surprises on the upside or the dollar strengthens sharply, silver could face some resistance. But for now, the short-term tone in the market remains bullish as investors focus on the Fed's next move and the broader economic slowdown.
According to the Post, the United States Geological Survey, or USGS, has added silver to the 2025 critical minerals list. That's a major development. The USGS only adds a mineral to this list when it's considered essential to the economy or national security, and when there's a supply chain vulnerability. This means silver is officially being recognized as a resource the U.S. cannot afford to lose control over. Silver's importance has always been tied to its industrial use in solar panels, electronics, medicine, and even defense systems. But now it's entering a new category of strategic significance. This move alone signals that silver is no longer just a precious metal. It's a critical industrial asset that could shape policy decisions in the months ahead. Now, let's turn to the post by Bai Xiaojun from November 6, 2025. Here's what it says. The market data on SGE and SHFE shows silver refining has been operating for 24 hours while accelerating imports, but it cannot offset the outflow of silver. Today, SHFE experienced a net outflow of silver. It hit a new low, approaching the panic line of 500 tons. That's a huge insight into what's happening in China's physical silver market. The SGE, the Shanghai Gold Exchange, and SHFE, the Shanghai Futures Exchange, are key centers for silver trading and storage. When Bai mentions a 24-hour refining operation, it means refineries are running at full capacity to meet demand. Yet even with non-stop refining and increased imports, silver is still flowing out faster than it's coming in. That's what's known as a physical squeeze, when real, deliverable silver becomes scarce regardless of what the paper or futures price shows. And when that net outflow hits the panic line of 500 tons, it means inventories are nearing critically low levels, something we rarely see in a major commodities market like silver. Next, the post by Silver Degen says, new critical mineral label could slap 25% tariffs on silver imports. Today's $48 per ounce could jump to $60. The U.S. imports 85% of its annual silver consumption. That's a very interesting point, and it connects directly to U.S. trade and supply chain policy. If silver is labeled a critical mineral, tariffs could indeed be introduced to protect domestic production or reduce reliance on foreign supply chains. But here's the catch. The U.S. currently imports 85% of its silver demand each year. That means only 15% comes from domestic mining. So, if tariffs or trade barriers increase import costs, that could tighten the market further and potentially make silver more expensive for industrial and manufacturing sectors that depend on it. This isn't speculation, it's a structural reality of supply and demand. If imports become more expensive while demand remains strong, prices naturally adjust upward. Again, this isn't financial advice. It's a basic look at how economic pressure can move through a system when a raw material becomes harder to obtain.
Now comes an interesting and historical take from Tim Hack. He writes, if we experience a renaissance of the 1970s, silver will be trading 10 times higher at over $400 in a year, and people are already so pessimistic. Don't forget the big picture or you'll go under. This kind of statement reflects how some analysts are drawing parallels between today's economic climate and the 1970s inflationary era, a time when silver and gold both experienced explosive moves. Tim's comment isn't a prediction, but it does highlight a sentiment, the idea that public pessimism often precedes major shifts in markets. Back in the 1970s, inflation was high, currencies were unstable, and tangible assets like silver became hedges against uncertainty. While history doesn't repeat exactly, it often rhymes, and that's the context Tim is pointing toward. The comment, "Don't forget the big picture," is less about price targets and more about perspective. When the focus is too narrow, it's easy to miss structural change happening beneath the surface. And then there's Jack Hoagland's post, which ties all of this together with official government action. He writes, the U.S. added uranium, copper, and silver to a government list of critical minerals as the Trump administration broadens its scope of what commodities it deems vital to the American economy and national security. That's confirmation straight from policy-level reporting, not just market speculation. When silver joins uranium and copper on that list, it's officially being placed alongside materials that are strategically necessary for energy, technology, and defense. This broadening scope by the administration suggests a shift toward resource nationalism, where nations prioritize securing raw materials critical to their own industries. It also underlines that silver isn't just about price movement. It's about economic resilience, industrial growth, and technological capability.